today I'm going to talk about the two assets portfolio return, understand deviation. What does this mean? Let's say you want to have a portfolio, you want to hold two stocks. Let's say two these stocks is Stamp and Best Buy. So this when you hold two stocks in your portfolio, so the portfolio return, which we often can say is expected return. Also, you can say is average return. So your portfolio return will be equal to the weighted of each individual stock. Then you add them together. Then how about the standard deviation? Is very interesting because the standard deviation, the way they were calculated, if you put two stocks in one portfolio, the standard deviation they can be calculated. They mathematically is follow this portfolio. So basically, is they are weighted of the standard deviation square. Then you have to add this portion is 2 they are weighted, then times the covariance of the two stocks. So you can see the covariance is equal to coefficient correlation times the standard deviation. Here's the example. So basically you say in my portfolio, I have a Best Buy and a Stamp. How much I'm holding them? I'm holding 50% each, right? So their expected return, let's say Best Buy expected return is 33%, Stamp is 35%. So based on this way, we can calculate the portfolio return. Now my portfolio return is 50% of the Best Buy return, 50% of Stamp return. So I added them together, give me 34%. So it's a little higher than Best Buy, a little bit lower than Stamp. Then how about standard deviation? So Best Buy standard deviation is 38%. Stamp standard deviation is 71%. So it's very volatile for Stamp. We use this formula. We calculate the standard deviation is 38.5%. So you can see the standard deviation just a little bit higher than Best Buy, but significantly lower than Stamp. So you hold you basically say you hold the Best Buy and the Stamp 50-50. You get a higher return than the Best Buy and just a little bit standard deviation, which is the risk. So what I go further, I want to see if I just hold proportionally by Best Buy and Stamp. Let's say, if it's I hold I hold 0 Best Buy, then hold 100% Stamp. So the standard deviation just equal to standard deviation. Then the return just is Stamp return. So that's a portfolio. So if I just hold 10% Best Buy, then hold 90% Stamp, I just increase a little bit of Best Buy. So then I can reduce my standard deviation, then not really reduce a little bit, the return. So if I continue to do this, we did the 50%. Then I continue to do this. Let's say I hold 75% Best Buy, then 25% Stamp. So this will give me a standard deviation is 31.91%. So you can compare this standard deviation is lower than Best Buy, lower than Stamp. So it's reduced my risk significantly. How about the return? The return is 33.75%. before. So just a little bit lower by Best Buy. So this can tell you, so this portfolio of risk can be significantly reduced by just holding proportionally of the Best Buy and the Stamp. Then also this weight proportion to hold each of them is matters. So basically I want to plot, I want to put all those numbers, this two set number on a graph. I want to see how the graph look like, right? So here's the graph. This is the standard deviation. This is the expected return. This dot is Best Buy. This dot is Stamp. Then you proportionally hold them. This all other dot is based on different proportion, the weight you hold them, right? So basically this graph tell you that this is Best Buy. Say if I just hold a little bit Stamp, so then I can increase my return. See, the return is increased. Then my risk reduced. So I hold a little bit more Stamp, then I increase return. Reduce risk, increase return, reduce risk. Then from here, then you increase. You will increase the risk will increase a little bit, but the return will go up. So basically, say from here to here, you just purely reduce the risk and increase the return. You just by holding a little bit more Stamps, you can increase your return and reduce the risk. So this is significant for you to understand why we always say to diversify, then hold different stocks, right? So this is tell you why they will increase your return, then reduce the risk for your portfolio. So another thing is you have to understand the Stamp and the Best Buy, before they had a correlation coefficient is negative. So how they correlated is matters. So if let's say this is a correlation coefficient equal to 1, and which means say if Best Buy increase 10%, Stamp will increase 10% return as well. So that's say they are perfectly correlated. So when they are perfectly correlated, so their portfolio standard deviation will purely equal their weighted standard deviation. So I plugged here. You can see their return not change, right? Their return not change, but their standard deviation, if you do 50% compared to before, 50-50 return not changed, that the standard deviation before 50 was 38%. So this one is 54%, which tell you, if they are perfectly correlated, so you basically cannot reduce their risk a lot. So tell you correlation coefficient is equal to this. Then this is again, say if correlation coefficient equal to -1, right? -1, this one actually is a minus sign. This is a minus sign. And so then your standard deviation will decrease dramatically. You can see before, say 50-50, the return are the same. So before the standard deviation was 38. So if the correlation coefficient is -1, this is reduced to 13%. So it really matters. So this is a graph actually from MIT, financial class lecture. So basically tell you, say this is perfectly correlated. This is perfectly correlated to stock. Correlation coefficient equal to 1. So what does that mean is if you perfectly correlated, you only can buy, reduce the risk, then you will reduce the return as well. However, if your correlation coefficient is less than 1, so you can buy hold them proportionally. You can reduce the risk, then increase the return. So that is the beauty of the correlation coefficient. The more they negatively correlated, you can reduce the risk without reduce the return. So which means to tell you, you should hold the stock they negatively correlated, or their correlation is less than 1. Conclusion is the weight of the assets matters in terms of reducing volatility of the portfolio. If the correlation coefficient is less than 1, less than the perfectly positive correlated, the standard deviation of the portfolio is going to be less than the weighted average standard deviation of the two assets.